Fraud training with UWM. Today we'll be discussing how it affects lenders and loan officers and the steps we can take to prevent the occurrence of fraud within the industry as a whole. Mortgage fraud is defined as a material misstatement, misrepresentation, or omission relied on by a lender to fund, purchase, or insure a loan. Mortgage fraud is harmful to lenders who face high risk of default when borrowers misrepresent their financial information. This can lead to a higher cost for mortgages in addition to more restrictive underwriting guidelines. A loan officer has a significant responsibility to ask relevant questions during the origination process regarding occupancy, income, credit, and funds to close to ensure the loan officer is not considered an accessory to any misrepresentation. Today we will cover the most common areas where misrepresentation can occur so that you can arm yourself with knowledge on these topics and not fall victim to someone committing fraud, especially in a competitive market where rates are high and buyers are fighting for properties. Anyone that has a vested interest in the loan closing can be a fraudster. This can include borrowers, real estate agents, and third-party processors. Be on the lookout for income misrepresentation. Borrowers might misrepresent income to support their annual household income when both spouses cannot be on the loan or to avoid additional documentation. Look further in depth at self-employed borrowers that recently took a salary W-2 position to make sure the situation makes sense, as this is sometimes done to avoid self-employment losses or documentation. Focus on whether or not the income is unstable or increasing. If it is, you may not be able to use this for qualification. Large increases in pay are a red flag to consider, especially when the borrower works for a family. We often see a family member who may give a temporary raise in order to assist with the loan qualification. In other cases, the income is entirely fraudulent and the borrower does not even work there. Don't fall victim to create income documents that cannot otherwise be documented. Pay stub generator sites are off limits. Always consider generic pay stubs as a red flag. It is a best practice to independently verify this income and employment if there are concerns. Also, do not recommend that the self-employed borrower change their tax returns or qualifications. Most CPAs are diligent and will report this fraudulent behavior. Finally, be sure to educate your applicant on the risk of changing jobs during the loan process. If the borrower loses their job unexpectedly or takes a position at a new company, you need them to make you aware so that you can properly qualify the borrower on the income level that they will be expected to continue in order to make the mortgage payment. That may mean you may have to delay the closing, and all parties of the transaction should be made aware. Occupancy misrepresentation is the second highest type of fraud that we see and can come in many forms. This is where the home buyer misrepresents their intended occupancy either to gain approval for a loan or to avoid paying higher adjustment for second home or investment properties. A principal residence is defined as a home that the borrower will occupy as their primary residence for the next 12 months, and they must take occupancy of that home within 60 days of the note date. Borrowers are less likely to default on their primary residence, which is why pricing is more attractive. Be diligent in looking for red flags and ask questions about the intended occupancy. If the borrower plans on renovating the home and it is certain that they will not move into the property within 60 days of close, the occupancy type should not be their primary residence. Other red flags may suggest the borrower is misrepresenting a primary residence would include the borrowers who appear to be downsizing. This could indicate a purchase of an investment or second home. The occupancy on the appraisal is vacant on a refinance. The commuting distance to the borrower's employer is unrealistic, especially when compared to their current residence. The borrower's insurance policy shows rental coverage, or on a refinance is sent to a different mailing address, and the taxes on a refinance do not indicate the borrower has a homestead exemption. Buyers may also misrepresent an owner-occupied property as an investment. This is called reverse occupancy, and it occurs when a borrower claims the home will be an investment property in order to use the rental income to offset the mortgage payment to qualify. In actuality, the borrower intends on moving in and occupying the property. Be mindful of cash-out transactions on primary residence. If the borrower mentions that they are tapping into the equity to be able to put the down payment on a new home, ask when the borrower intends on taking possession of the new property, and if that will be their primary residence. If so, the refinance transaction may need to be done as a second home or investment. You can protect yourself against occupancy fraud by asking good questions and revalidating some of the information. Check the address on the documents submitted to you to see if they make sense, and re-verify any lease agreements to confirm their authenticity. Keep in mind the mortgage does allow for extenuating circumstances if the intended occupancy changes after the loan closes. Have your borrower reach out to the lender or servicer for approval. The last item we are covering today is misrepresented credit. This includes undisclosed debt, straw buyers, and renting credit. We recommend that you are diligent when interviewing your applicants. Remind them to avoid taking out any new debt during the loan process, especially new car loans or leases or any other mortgages. If they must, make certain that they know to alert you so that you can properly consider this debt in qualification. UWM offers a welcome video to your client when the loan is in underwriting to inform them of these reminders. Another way to combat fraud is to educate yourself on straw buyer and the potential of renting someone's credit history. Both fall into the category of misrepresenting the buyer's true credit risk. A straw buyer is a person, usually a family member, who allows someone to use their credit in order to qualify for a mortgage. Be on the lookout for large gifts for down payments, especially if it's given to a parent from a child, in addition to non-borrowing family members that will be on title but not on the mortgage. We sometimes find the straw buyer has a misunderstanding in thinking that they are co-signing for a mortgage rather than committing fraud. Finally, renting credit history is another form of fraud where someone will add the applicant to a credit account as an authorized user. This falsifies the borrower's credit history and can mask the true risk of extending credit to that individual. We will all need to work together to battle mortgage fraud, as we have a duty to protect the mortgage infrastructure and financial services in general. Losing your license, being placed on a lender's or investor's ineligible list, fines, and jail time are not worth the risk. Also, this is your livelihood, and with some upfront diligence, you can ensure longevity and continued growth in the mortgage business. The UWM website has an option for reporting suspicious activity that is available to our clients and borrowers. The Report Suspicious Activity link is completely anonymous, and the concerns is immediately shared with our financial investigations team. Thank you for watching.